Gold and silver are hot right now, but a lot of investors are walking right into a tax trap.
So you think your gold profits are taxed, just like your stocks, right?
Well, that assumption can be a very, very expensive mistake to make.
It all comes down to how the IRS sees your gold, and it's probably not what you think.
It's all about one word, collectibles. And that one little word, well, it changes everything.
Basically, almost any physical metal you own, coins, bullion, even jewelry, falls into this category.
So what does being a collectible actually mean for your tax bill? Let's get to the number.
It means your long-term gains can be taxed at a whopping 28%. Yep, 28. Now compare that to the 15 or 20% you'd pay on most stocks. Big difference, right?
And this is where people really get burned, especially with some popular ways to invest today.
You might think, I'll just buy an ETF to get around this. Makes sense, but
Nope, for many big ETFs, that 28% tax still applies because they hold the physical metal for you.
And if you're thinking of selling jewelry, there's an extra little twist that can really sting.
It's considered personal use property. So if you make money, you owe tax. But if you lose, tough luck.
okay, so what do? It means you have to start thinking differently about your returns.
Look, a 10 grand gain is not a 10 grand gain. What you actually keep is totally different.
Because at the end of the day, it's not the headline number that builds wealth. It's what's left after tax.
But here's a key difference. ETFs that own mining stocks are taxed just like regular stocks.
All right, let's put this all together. Here's what you absolutely need to remember.
Knowing this stuff isn't just a nice-to-have. It is absolutely critical for making smart moves.
The single biggest mistake you can make is just chasing the hype and completely ignoring the tax bill.
So ask yourself, are you just chasing prices, or are you building real, actual, after-tax wealth?